Hey everyone, Chris Urso here with URS Capital Partners and URS Properties. Wanted to take some time to go through our fourth quarter review. So we've been doing this now, I believe this is our sixth or seventh quarter consecutively, and we remain committed to it. The world's been a very interesting place in our space, really since I'd say beginning of 2022 when rate cuts started. We were coming off of a year and a half of unprecedented historical rent growth and properties trading at peak valuations, very highly compressed cap rate environment. And now we are in the opposite end of the spectrum where, we're seeing interest rates 10-year hovering around anywhere between 430, 460, 470, depending on the day, big 50 basis point swings week over week. Supply in our space is peaking as we speak, so rent growth has been muted for the most part throughout the majority of our growth markets that we're in. Occupancy is a battle day in and day out, but opportunity exists in times like this. So it's not all doom and gloom. It's a challenge, make no mistake, but I feel like it's even all more important to kind of convey exactly what's going on in our portfolio. I'm going to touch a little bit on what we're seeing in the market, and for those of you that haven't received, we did a very comprehensive kind of year in review and 2025 outlook. If you'd like a copy of that, please feel free to just email Rebecca at urscapitalpartners.com. We're happy to get that over to you. So I'm going to go ahead and get started. There's a lot to cover here. This is going to be one of the more lengthy ones, so I apologize in advance. But if you have any questions after you review this, feel free to reach out to Rebecca at urscapitalpartners.com, and happy to jump on a call. So for those of you that either currently invest with us or are considering investing with us, I'm going to give you a little bit of an overview of URS Capital, try to play around with that a bit, and take you through kind of who we are and when we got started. So we bought our first apartment deal in December of 2009. Since then, we've been involved in 33 transactions, almost $1 billion of transaction value since 2009, all dedicated purely to multifamily. So we don't do any other asset class. Thankfully, from our tremendous investor base, we've raised over $300 million of equity to do those deals. On the acquisition front, which is our value add, opportunistic, distress platform, we've done nearly 5,000 apartments. We also began starting in a very kind of bespoke and strategic way, ground up development back in 2019. We're now about to open up over our 1,000th unit, so 4 projects, over 1,000 units of ground up development. Since then, we've also sold 23 of those 33 assets that we've acquired. We did primarily did our selling through 2019 through actually January of 2024. We sold our last deal of this cycle. And I think from that time, that represented more than 12 or 13 of those 23 exits since 2009. So our active portfolio right now consists of about 2,300 units. One of those opening up, which is our Asheville luxury apartments, is going to be called the Ash. That's opening up our first buildings here at the end of the first quarter of 2025. And will be completed by year-end /Q1 26. Big project, Class A institutional, really Class A plus institutional grade asset. It's going to be one of the best projects probably in the entire Asheville market when we're done. But you could see here, our focus continues to be in the Southeast for the most part. I'm going to touch a little bit on our forward-looking strategy as we get towards the end here. But a couple of, highlights related to our track record again. We've sold 23 assets. We have nearly 270 active investors across our portfolio. On those assets we've sold, we've averaged an IRR of 32.9%, equity multiple of just over 2.07, with an average hold time of about 40 months. So some of the highlights from 2024 that I wanted to touch on. Let me see if I can go back here. Let's do this. There we go. That slide's not showing up. Okay, so we had 4 acquisitions, which I don't know why that's not showing up in 2024 before we get into our refinances, but we had 4 acquisitions in 2024, a total of 6 properties. We were very active. 3 of those projects were loan assumptions. One was an all-cash purchase of a highly distressed asset. In addition to those acquisitions, we had completed 2 refinances, one of a new construction project in Rock Hill, South Carolina. So we refinanced that out of our floating rate construction loan and put it on 7-year fixed rate, Fannie Mae full term interest only. And we also refinanced a big value add project that we did down in Savannah that was coming off of a bridge loan. So that was a 232 unit property that went through a $5 million renovation, took the rents up nearly $600 on average, and put that into a 5-year Fannie Mae loan as well. So total refinance proceeds were about $60 million across those 2 projects. In addition, we had 2 sales in 2024. Latitude Richmond Hill, we had owned that project for about 4.5 years. We bought it from the original developer. It's suburban Savannah, great asset, great market. We just felt that it was a good time to exit and extract a meaningful amount of upside to redeploy into some lower basis assets. So we did great on this project, 29% IRR, 2.7 multiple. Sold that in January. We also sold a piece of land that we had acquired about 2 years earlier and taken through the full and final entitlement, shovel ready. It was a bear of a project, 220 acres in Murfreesboro, Tennessee. It sits right behind the 288 unit apartment project, Farmhouse Apartments, that we developed as well. And we decided to sell that to a public home builder. It was 391 single family lots. So it was an all cash unlevered 8 IRR in about 2 years. So not a grand slam, but good deal. We monetized our efforts for our entitlement process and permitting. So we delivered it to them turnkey, shovel ready. So now I'm going to go ahead and jump into the 2024 update, which is, pretty much our URS Properties, which is our dedicated in-house property management division that is exclusive to URS owned assets, right? So it gives us complete and total control of our portfolio. While we're 2 companies, we kind of run with one vision, which is really to, do the best job we possibly can on behalf of our investors and our residents day in and day out. And you can see our portfolio now at this point, our average age is no older than 20 years across our portfolio. So everything from, new development to the deals that we acquired this year ranged from mid-90s to early 2000s vintage product. So super excited for that. So Flats at Leland we acquired in Wilmington. That was a distressed deal. This is Views at River Bend we acquired in Beaufort, South Carolina. Sorry about that. And that was 244 units. And 248 units, in Beaufort, South Carolina. We bought that on a loan assumption from a long-term owner. They had the asset for 15 years. We had great agency financing in place. We also acquired Belmont Heights up here, which is in Belmont, North Carolina, suburban Charlotte. Great workforce project, 186 units, combination of townhomes and single-story units. And really great location, great submarket. Another loan assumption with over 6 years left on Fannie Mae financing at, I want to say, mid 4% rate. So really excited about the deals that we acquired. In addition, we acquired a portfolio of 3 assets, all built from the late 90s to the early 2000s from an original developer in Asheville. Lowest rents in the entire market, but came with 9 years of term remaining on 3.5% Fannie Mae financing. So, our portfolio really spans North Carolina, South Carolina, Tennessee, Savannah, Georgia at the moment. So I'm going to walk you through our key metrics here that we track quarter over quarter and we've been reporting on. Let me find a good place to stick my mug here. There we go. So this first slide is really occupancy, and it kind of shows traffic, tours, and net leases and occupancy at the close of Q4 versus occupancy at the close of Q3. And you'll see some softness in occupancy for sure. It was a rough quarter across the board between supply peaking, seasonality in most markets, the holidays, weather, hurricanes, etc. Snow in the south. They came in early January. A little bit of a compounding effect, and it's been a bit of a dogfight. But we feel like we're getting to the other side of that, and everybody's really excited for kind of spring leasing. We're starting to see traffic pick up across the portfolio, and really excited to kind of get through January, which we are now, and kind of towards mid to end of February is when we typically start to see things turn a bit from an occupancy side. But you could see here, leads and tours to net leases across the portfolio. Belmont and Charlotte, net leases 7 for the quarter. Creekside, Arden, that was the Asheville property we closed in October. Collectively, the 3 assets had 14 leases. Crescent Place in Savannah, 14. Flats at Leland, 8. Latitude South Portland, 23. 16 in Rock Hill, 12 at Views, 19 at Farmhouse Apartments, and 74 at Cobalt Row. So, occupancy is pretty much consistent in Belmont. Creekside's doing really well. The entire portfolio today is kind of in the upper 90s. I want to say like 96, 97%. Crescent Place, closed the quarter out for fourth quarter, down pretty meaningfully on occupancy. A little bit of a dogfight there. And we are back up to 90% already as of yesterday. Flats at Leland, this was a distressed property, so intended. We bought it with 40 some odd percent physical occupancy, but we quickly purged that down to about 25, 26 of real true occupancy by forcing vacancy, evictions, non-renewals of non-paying tenants, etc. It was highly distressed. I mean, the property was unattended to for probably the better part of 6 months prior to us closing on it. And we went in there and have completely attacked it, serviced all the good paying residents, got the pool back online, power washing, office up and running, staff there, cleaned up all the landscape in the grounds. So all that's rebranding, outreach marketing, etc., all in preparation to kind of really hit spring leasing hard. Latitude at South Portland, winter months, coupled with an expiration of a corporate lease to a minor league baseball team, which we knew they were vacating about 12 apartments in October, and then that coupled with challenging weather in the Northeast. Maine is typically very slow, November, December, January, February. That property has been running north of 95% on average. As you can see, we were 98 in Q3, so we expect that to kind of come back in the springtime here. Exchange in Rock Hill held pretty firm, pretty solid, no major movement there. Views at River Bend, some of this is forced vacancy. We're going through a major renovation reposition, so we closed on this really late July, call it August 1st. It was a very long contract period. It was a loan assumption, so I want to say we were under contract for almost 4 months, which is never great. Long-term owner, very, very nice people, very good group, but we saw staffing kind of deteriorate week over week, month over month. Performance was deteriorating. They had one person on site. When you're in a sale, it's always a challenge to keep operations, static at status quo. But when you have an extended period of being under contract, it becomes a challenge to retain staff and keep people motivated, etc. And we're also doing, close to a $4 million renovation there. So everything was 100% original on this property, built in 2001, great floor plans, amazing views of the marsh, great amenity package. So we've gone in and since September, completely renovated clubhouse, club rooms, party rooms, outdoor kitchens, marsh view decking, pergolas, decks around the pool, landscape cleanup, power washing the whole property, and now we're implementing our unit renovation program. So a lot of this was kind of forced while we were going through the reposition again through the slower seasonal months and to be prepared for spring leasing season. Farmhouse Apartments was a lease-up deal. Murfreesboro gets extremely slow. We did only 19 leases in Q4. We averaged over 24 leases a month from April through August at that property per month. So we knew seasonality was going to get us a bit there. Very frustrating when you're in a lease up now, hitting a slow period when you're right on that precipice. You can see we're right at 88 and a half. It's called the back door is open, right? So you have your first batches of move-ins that are expiring in slower months now. Even if you're doing a great job retaining, north of 50, 60% of your expirations, you're still getting 5 or 6 move-outs in any given month. And if you're only leasing 4 or 5 apartments or 6 apartments in a given month, you're kind of net neutral. And in some months you might have 8 or 9 move-outs and you only lease 6. So excited to kind of turn the corner on fourth quarter here, we expect that to really come ripping back. It's proven itself out over the last 18 months that really come March through, August is when that market rips. And it's a pretty tight market. Once we get stabilized, there's no new supply really coming online there. It's very challenging to develop in and around Murfreesboro right now. Lack of sewer capacity, lack of zone changes, etc. So Cobalt Row, steady horse, student housing deal, kind of the best student housing property in all of Murfreesboro that services MTSU. That's 750 beds. So 618 leads because that's basically leasing season. Really starts and ends in August 1st and move-ins start in kind of mid-August. So you kind of had the hangover last little bit in September there of leasing to get us up to 100%. But 750 bedrooms, so that's 750 leases essentially on that property happened and moved in between August and October. So really happy, great asset. We bought that during COVID. Thrilled, I want to say it's 2009 construction, cottage style. Really, really happy with it. But really the underlying theme here is supply peaking along with seasonality across the board, between holidays and winter months is real. Our teams, we're talking to them daily, weekly, site visits, structured calls, are doing everything they could possibly be doing. We are not concerned. We knew that 24, late 24 through all of 25, in my view, is going to be a challenge on operations. But again, these challenges we're prepared for. We're well capitalized. We're not over levered. We don't have any pending loan maturities in the entire portfolio here. So we can really play strategic offense. We want to continue to invest in our assets. We think it's going to start to turn the corner towards the tail end of this year in most of our markets, and really through mid-26, 27, 28 is when we expect to start to really see some outsized rent growth based on all the data that we're following in terms of supply falling off a cliff for the most part across our markets. But all the headlines that are out there, I don't necessarily agree with them. A lot of the public REITs, I listen to their earnings calls every quarter. They were calling peak of supply, Q3, Q4 of last year. I don't think we're there yet in most of the major markets in the Southeast. Charlotte, Raleigh, Nashville, Savannah, Charleston. I think we are in the throes of it as we speak, and it's going to be a bit of a dogfight, and we're ready to have that fight. I really thank God that we were super disciplined in 21 and 22. You look at the assets that we have here. 6 of these were bought in 2024. So we really brought our portfolio down to 5 or 6 assets, 3 of which at the time were brand new construction, and 1 was a student housing property. So we had 2 conventional deals at that point. We stayed very, very disciplined through 21 and 22 for the most part on acquisitions when other groups were buying 5, 6, 7, 8, 10 deals a year. We are so hyper focused on our deals and so hands on, and I can't imagine what some of these other shops are going through. When they're staring at 15, 20, 30 deals that are on floating rate debt, getting squeezed, negative cash flow situations, and a softening market where you're not getting rent growth, you have to fight for your occupancy, etc. So I believe that we're in a really good position. Our deals are well capitalized, under levered. I think our average loan to cost across our portfolio is probably about 59%. So move-ins and renewals, as you can see here, this is move-ins on the, let's see if I can do this. There we go. Do the pen. This was previous quarter, number of move-ins current quarter. So you can see, we're pretty much down. Creekside and Arden we bought in the fourth quarter, so that's up. But we're down on Crescent Place. We're down on Bellman Heights. Flats at Leland, we started really in October. Latitude at South Portland, up slightly. Exchange of Rock Hill, down materially from Q3 to Q4, so very seasonal again. Views at Riverbend, kind of static, but Farmhouse Apartments, take a look at this, 67 move-ins in Q3, 19 in Q4. Cobalt Row, 12 move-ins, but Q3, as I said, August is when we get the majority of our move-ins. and renewals here. So on the renewal side, we did pretty good for the most part. Did great at Belmont. Creekside again was so early. Crescent Place, we did great, well north of 50%. Flats at Leland, we forced all this out upon takeover. Latitude at South Portland, it was below 50% on our renewals. So, we kind of like to see these numbers, obviously, the renewals outpacing the move-outs, as you can see here. So pretty flat at Rock Hill. Views, we did a good job. I think tenants, the longer-term tenants there, were responding very well, seeing the effort and movement that we've had so quickly upon takeover. So that we're very confident that's going to pick up some steam there. And then here at Farmhouse Apartments, this is a big reason on the dip in occupancy. So primarily home purchases. It's great demographics in that sub-market. So you are going to have qualified folks that could go buy a home or job relocation. We're really the two main drivers there. But again, we feel very, very good. Real estate is a long game. I think a lot of folks, we got accustomed to, the market trading like commodities or equities where you could buy a deal, sell it in 9 months, do nothing, and 2x your equity. This is fundamentals are back in the market, which is basically doing a market cleanse of inexperienced operators that started in 2019 and just started flipping deals in late 2020, 21, looking like geniuses. Now you have to fight and earn your operations, earn your value that you're going to create day in and day out. And we're very confident in our long-term thesis across our portfolio. Our underlying drivers in our portfolio, really our three core values are, do we want to own this asset for 10 years? Are we in a market that we want to be in for 10 years? And are we capitalized appropriately to own this asset for 10 years, both from a debt and equity perspective? And we feel really good about every one of our assets being able to check all three of those boxes. We passed on a deal that we liked the story a lot on over the last few weeks in a market which we want to get into and expand in, kind of the Raleigh MSA. And it was everything that we wanted. It was a distressed situation. Sellers were taking a massive loss on the deal. It was bought for $220,000 a unit 2 years ago. We could have bought it for $160,000 a unit, and it was 200 units. And I just, the location I liked, the size of the deal I liked the story, but at the end of the day, I didn't love the asset, and it wasn't an asset that I could confidently sit here and get on the next update with you and say, this is an asset I want to own for the next 10 years. So we're trying to be really smart in our acquisitions as, the market is extremely inefficient and challenging to navigate on all fronts, and make smart decisions and be comfortable putting a 3 to 5, 5 to 7, 7 to 10 year hat on with these good assets and good locations, because we know what's going to happen, right? And I'm going to touch on that in a little bit. So bad debt is really, knock on wood, we have no major concerns at the moment across our portfolio. I know some folks are really struggling in some other markets. I will say kudos to our team. They do really a great job on collections and screening. We have not gotten really exposed as much as some other shops have on a lot of fraud that took place in the market over the last kind of 12 to 24 months. So we feel really good about kind of our demos and our assets, really, at the end of the day. So nothing really too alarming here. The 18,000 at Cobalt Row, again, that's purely because their leases all run from, I want to say, August 17th to July 31st. So every lease is on the same schedule at that property. So once we get through the move-out season in August and we realize, okay, who's carrying balances, who are we not going to be able to collect on, that's when we take the write-off. So you can see last quarter was 0, and that's basically our write-offs from end of lease terminations. So NOI growth, this is a tough chart for some of the new deals. Obviously, we don't have our comparison to compare to, but you can see Belmont Heights quarter over quarter, really strong growth on NOI. Crescent Place was down pretty materially quarter over quarter, primarily driven by occupancy, which we touched on earlier. We closed out Q3 at 93% occupancy, closed out Q4 at 87.8, I believe. So that's a meaningful number on 232 unit property. But we are back up to 90, and we're looking to get back to this level, if not higher, for Q1. Flats at Leland, negative NOI to be expected. We're 26% occupied, going through a big reposition. No major concern there. Latitude at South Portland, this was really occupancy driven. It's probably the first meaningful dip in NOI that we've had in close to 4 years there. But primarily occupancy driven. We expect to see that normalize come Q1 as well. Exchange at Rock Hill, strong quarter, even though it was a little bit slower than Q3. We're now in that stabilization mode. Views at River Bend, strong quarter relative to the prior quarter. Farmhouse Apartments, this is in lease up, so that should continue to grow. Cobalt Row, really, really strong quarter relative to the prior quarter. We've gotten consistent 7 to 10% increases per bed since 2021 on this asset. So, now 4 years running, and we're pre-leasing great for the 25-26 school year. So this chart's going to be better over time because it's basically taking the trailing 12 currently over the trailing 12 prior year. So a lot of these deals are in there, obviously the newer deals are all in their first years. Crescent Place, though, you can see we now have year-over-year comparison. Very strong. Latitude at South Portland, year-over-year, which, again, this is an important thing because you look at a quarter and say, okay, all right, Latitude South Portland had a tough quarter, but annualize that out year-over-year, we've grown NOI 13%. Crescent Place didn't have the best quarter. Year-over-year, we've grown NOI 22%. Rock Hill, artificially inflated. It's a lease up, obviously. Views at River Bend will start to pick up, momentum there and have more data to compare to. But Farmhouse Apartments, again, that's in lease up, so that's going to continue to grow, year-over-year, quarter-over-quarter. Cobalt Row, stabilized asset, really just haven't had a hell of a year. Team's done a fantastic job there. So the unsung heroes of property management are the maintenance teams at these sites. Most people, and I don't want to say most people, a lot of people in 2020, 21, 22, you didn't have to be a good operator. You didn't have to be a great management company. Rents are going up 10, 15, 20% doing nothing. Just on renewals and new leases. Somebody vacates, you turn an apartment, you don't even renovate it. You paint it, you clean it, and you're getting 15, 20% more in rents. You didn't have to pay attention to all these KPIs as much because it was just great news every week. But this is really kind of the secret sauce of, your office team and your maintenance team really coming together to create value day in and day out for your residents, to get those residents to want to stay at your properties and want to lease at your properties. Everything from curb appeal to amenities to cleanliness to, service, professional service, responsiveness. A lot of folks don't realize the amount of moving parts on these sites. We've had, you look at a place like Crescent Place, 309 work orders were completed in the quarter. Latitude South Portland, 200 almost. Exchange at Rock Hill, 270. Views at River Bend, 240. Farmhouse Apartments, 389. 289 at Belmont Heights. Right, this number at Flats at Leland is going to probably be meaningfully higher for the next quarter, even from the existing residents. When we did unit walks there were folks living with no ACs, no hot water working in some units, just various issues that we went in and basically brought a SWAT team in for the first 30 days. We had 5 of our maintenance guys and we had an external turn crew going in and turning units and getting product online, to really make sure that those residents that were paying and stuck it out through tough times were getting a good product. But at the end of the day, this is really, we play in kind of call it gray collar housing. So kind of, call it your $50,000 to $120,000 household incomes. Most of our tenants are likely not going to be able to buy a home in the foreseeable future. So we want to provide, as good of a living environment as possible, whether it's a 1970s vintage property or a brand new asset. I always instill in our team when we walk on a site that it should be the best that it can possibly be for what it is. Cleanliness doesn't cost anything. Doesn't matter whether it's a Class A or C deal. It should be clean. Curb appeal, same thing. Responsiveness to your tenants, respectfulness to your tenants, servicing them in a professional way. That doesn't matter whether it's Class A, B, or C. These are the things that need to be done day in and day out, and we're very fortunate. We've got a great team, led up by George Jackson, who's our head of maintenance for Urso Properties. We couldn't be happier. George has been with us a long time, but these are the things that happen day in and day out that investors don't see, owners don't see or pay attention to a lot of times, but it's critical to the underlying success of an asset. So a couple things, so touched on a lot. I'm going to try to stick that over there. So as we move forward now into 2025, again, if you haven't gotten our year-end and 2025 outlook, please email Rebecca at urscapitalpartners.com. We'll get that over to you. But this is why we're really excited. I mean, we want to continue to acquire assets in this dislocated environment, right? So while distress might not be rampant, it is still a highly dysfunctional market right now. And these are the things that we want to capitalize. These are the times when we want to capitalize, right? You have sellers and buyers. There's a big gap. You have sellers holding on, trying to buy more time, another 6 months with their lenders, another 6 months with their investors, hoping that things are going to get better. But the reality is nothing is better today than it was a year ago. So for those folks that bought extensions, bought rate caps, trying to say, hey, in another year, rates are going to be lower. That was one thesis from a very large syndicator that I spoke to face-to-face when I asked him, well, what's your plan? Well, the bank gave me another year. I said, okay, but what's the plan? And this was almost a year ago. His plan was, well, rates have to be lower a year from now than they are today. So maybe I'll be able to refinance. That is not played out. Most of the deals that we're looking at are requiring significant cash in to right-size their loans that are there. So we're taking a very proactive and offensive approach in building our pipeline. We get anywhere from, it's been consistently 4 to 5 deals a week that are coming into our office for us to scrub down and see what we want to spend our time on. Now, it's very inefficient and it's very exhausting at the same time in this environment because not a lot of properties are necessarily going through the perfect, cleanest marketing process with appropriate pricing guidance based on the asset and the performance. It's a lot of, hey, the seller needs to get this. I just had a joke with one of our close relationships on the broker side. There's a deal we love. We've seen it on and off probably 6 times in the last 14 months. And this isn't a distress situation. It's just a large seller that would like to harvest a gain, but is stuck on pricing from 3 years ago, 4 years ago, when we have our numbers, $35 million. And the response from the broker is, it was $35 million from us, 3 months ago, it was $35 million from us. 6 months ago, it was $35 million today. And the response from the broker was, they need $39 million. My response was, I need a lot of things in life. That doesn't make sense. So we'll continue to watch it, and that's it. But we have to sift through a lot of the noise to figure out where to spend our energy. But to us, that creates opportunity because I don't think there's a lot of shops in the private capital side that have the ability to do those things that we can do really well, which is be super disciplined with our pipeline, follow up on deals, get everything in there, keep it in an organized fashion. And when we're told no, not just forget about it and move on to the next one, but meet on it and discuss it weekly, check in with our relationships, whether it's brokers, lenders, owners directly, and try to shake things loose. We've always played the, quality over quantity game when it comes to acquisitions. We've never been a fee-based business. Yes, we have to make reasonable fees to keep our lights on and support the infrastructure of our teams to continue to do deals and do them well. But we've always been focused on the back end of these deals and the value creation and the upside that we feel we can create. So our number one thing is avoid the big mistake in this type of environment and continue to acquire good assets with a good thesis and be patient. So we're looking at everything from distressed sellers to long-term owners, funds that are at the end of their life term, right? So you have funds that were created either with 5, 7, or 10-year horizons that unfortunately are maturing now in not a great time, but legally they have to exit those assets to create liquidity for their fund investors. So it's a great opportunity on that front. We all know about, the loan maturities and the floating rate loans that are out there. We think we're going to start to see some more of that come to a head this year. based on timing. A lot of those loans were done in 21 and 22. So those loans in 21 were typically 2 to 3 year type loans that now the extension's already been exercised. So now what is the seller going to do? Nothing has gotten better. So are they going to meet the market? Are they going to transact this year? Or are they going to have to call $4, $5, $6 million of a capital call to right size their loan for a refinance? So we're looking at that. We're looking at new developments that are in lease up. Maybe that the lease ups are taking longer than everybody wanted them to. We see that in our own portfolio. We're seeing rents aren't growing as fast as they once were. Some operational issues, physical issues, capital constraints. So the other thing we're seeing on these deals, the floating rate deals that were done as value add, is when rates started really running and the market started getting softer, everybody pulled back their cash because they were in a negative cash flow situation. So now they didn't continue to invest into their assets. So we're seeing things start to deteriorate where maybe their business plan was to go in and change out all the cabinets. They went in and painted them. Maybe it was to put granite or quartz in, they put laminate in, or they're just doing kind of hard turns versus the upgrade programs. Their amenities are lacking. They wanted to redo the pool, but when they saw rates rising, rents declining, they pulled back and said, no, we're not spending. So the other thing that's really exciting here is, starts minus completed in October by year in the thousands. So if you could see here, we had 258,000, give or take, is that 258, completed more than started. So this is some of the lowest levels since the 70s in terms of starts versus completions. So we're seeing that number continue to decline, and that's because of higher interest rates for longer, rents are softer, institutional developers want to see positive rent growth before they put a shovel in the ground. Equity is harder to raise for development in this environment. So we are really, really bullish on the ability to buy good assets, put the hat on, look out 3 years. We really think there's an opportunity to see outsized rent growth. And when we start to see the positive rent growth coming into the market, the other side of the equation is there is a tremendous amount of liquidity that's on the sidelines. And we don't want to be buying when that capital is released. We want to potentially be selling into that environment, whether it's 3 years out, 4 years out, or 5 years out for some of these assets, because we want to be buying when capital markets are inefficient. Equity, there's a lot of uncertainty, so that institutions can't really deploy capital. They don't know what's going to happen with the new administration, with interest rates, with rents, with supply, etc., with the macro economy. So being that we're private and more entrepreneurial, we see a great opportunity to go in and pluck off and continue to accumulate assets that we feel we can have a clear path to get to a 6 to 10% cash return over the course of the next 2, 3, 4 years. It's not going to be immediate. It's not going to be day one. It's going to be painful, some of these updates, but we believe that there's a game there and an opportunity there to get to that north of a 6 to 10% cash return inside of 24 to 36 months. And at that point, we have a free call option on the market. We are getting paid very tax efficient cash flow to wait for liquidity to open up and improve and capitalize on selling into a market where liquidity is much greater than it is today and demand for assets is much greater than it is today. So that's really our thesis that we believed and laid out in 23 and started to implement in 24. We've played all the defense we need to play in terms of our assets that needed to be refinanced earlier this year. We got through that, and now we're looking to continue to accumulate. So really, at the end of the day, our target markets continue to be North Carolina, South Carolina, Tennessee, Savannah, Cincinnati, Northern Kentucky is where we got our start back in 2009. We would be open. We want to get back into that market. We think there's some good opportunity there. And we're starting to branch out statewide and look for some of these kind of secondary cities and towns that have a little bit tighter supply-demand stories than some of the major metros, where it's a little more challenging to develop in some of these suburban towns in and around the Charlottes, the Nashvilles, the Savannahs, the Charlestons, etc., where we can find some good opportunity and take advantage of an imbalance in a positive way of supply and demand. So as I'm a big fan, for those of you that don't know, of Sam Zell, number one, and Howard Marks, number two. The worst of deals or the worst of loans are made in the best of times, and the best of deals or best of loans are made in the worst of times. And I think that cannot be a more perfect summary of what went on in 21 and 22. And we believe that we are in, one of the more challenging times that we've seen in our space over the last 15 years. And we really are bullish that the deals we're buying today, we're going to be very, very happy owning over the course of the next 5 years. So if you'd like to learn more about us, if you're not already an investor, please reach out to Rebecca at urscapitalpartners.com. Thanks so much for taking the time.